Hey there, Brad Castro from GridOptionTradingStrategies.com. I've got an absolutely crazy put-selling trade and trade repair to tell you about today. One that would have been a disastrous investment for long stock investors, but which turned out to be a big winner for us inside the Leveraged Investing Club. The stock had a 55.19% drawdown on us, but we walked away with 26.19% total returns or 20.21% on an annualized basis. Yeah, we were in it for a while too, 473 days in fact. So in this video, we're going to drill down on the trade, look at how ugly the stock performed, go through the trade management and repair decisions we made and why, and then identify why the campaign ended up being such a success. This one definitely has some things to teach us, which we would be wise to pay attention to so that we can hopefully replicate the results in the future if we find ourselves in a similar trade. But before we get into all that, a little background. I've been trading options, mostly selling them since 2002. I launched the Great Option Trading Strategies website way back in 2008, where over the last 17 years, I put together a ton of resources, free downloadable guides, ebooks, special reports, case studies, etc., and nearly 300 articles on all aspects of selling options for income, as well as incorporating options into value investing and or dividend growth portfolios to further improve and accelerate those processes as well. And 13 years ago, I started my private option trading membership site, the Leveraged Investing Club. Now, I only offer membership to the club once, possibly twice a year, and only to readers of my daily options, tips, and insights newsletter. So if anything we cover today resonates with you, you might want to sign up for the newsletter. And for that matter, you might also want to check out the Great Option Trading Strategies website and all the resources available to you over there. I've added links to the site and the free downloadable library page in the description below. And I've also pinned a direct link to my daily option tips and insights newsletter sign up page in the comments section. Okay, so let's look at this crazy ass trade today on Papa John's from 2024 and well into 2025. And the best way to get started is to first review my concept of option selling as a form of heads we win, tails Mr. Market loses. I talk about this a lot because it's this flexible and forgiving nature of option selling that's one of the main reasons why I love the strategy so much. Basically, it comes down to this. I make great returns when I'm right, and almost always, I still make okay to decent returns when I'm wrong. That's a pretty good deal in my book because believe me, I'm wrong plenty of the time. If I sell puts or covered calls for income on a stock that I don't believe will trade lower or lower by much in the near term, and I'm right, then I set myself up to make easy, lucrative, high-yield annualized income over that near term. Same thing if I sell calls or bear call spreads on situations where I don't believe the underlying stock will trade higher or higher by much in the near term, and it turns out that I'm right. That's heads. But what about tails? What happens when things don't go as planned? When I'm wrong and the stock moves against my position? This is where that flexible and forgiving nature of option selling comes in. Now let's be clear, when you sell options for income, what you're really selling is the time value component of options. And at the end of the day, unless you're adding more capital to a trade, which we sometimes do, it's this ability to sell more time value that makes all trade repair possible. I've covered trade repair in other videos, and I'll include a link to my option selling trade repair playlist at the end of this video. But when I talk about trade repair, I'm not talking about simply fighting back to some sort of break-even status on a trade. We're not looking to fight Mr. Market to a draw. We're talking about still having a profitable trade or walking away with more money than we started with, and often in the okay to decent range. So a typical return on a repaired trade might be in the 8 to 12% annualized range. And what, isn't that what the long-term average annual return of the stock market supposedly is? Okay, you're not going to win the lottery overnight with that, but those are the bad trades. When 8 to 12% a year on bad trades is obviously a whole lot better than big fat losses. But sometimes we do considerably better than that on our repaired trades. In a recent video, I detailed 4 successfully repaired trades we closed in 2025, 2 of which resulted in much better returns than that 8 to 12% annualized ROI estimate. One of those trades was where we sold puts on Celsius Holdings, only to have the stock trade 48.82% lower on us at one point. And yet we walked away with 17.04% annualized returns over 248 days. Even better, we sold puts on ELF. The stock had a 34.16% drawdown, and we still banked 19.43% annualized over 85 days. But today's trade repair campaign I want to show you on Papa John's takes the cake, or rather the pie, both in terms of total and annualized returns, as well as just how long we are in the campaign. So in this video, I want us to look at three things: just how ugly the trade was, the trade management and repair decisions we made, and then identify what I see as the three main reasons why the trade worked out as well as it did. Because again, this trade has important things to teach us that we may be able to apply to similar situations in the future. So first, ugly trade. Well, yes and no. It's hard to call it a truly ugly trade when the final walkaway returns ended up being what they were. But in terms of a comparable long stock position, it was an absolute disaster, and still is to an extent. Keep in mind, when you sell puts on a stock, you're basically insuring that stock at a certain share price. In this case, we sold $65 puts on Papa John's when the stock was trading at $67.33 a share. I incorrectly believed that there was a floor in the stock at $65. So in other words, we told Mr. Market that if the stock was trading below $65 a share at expiration, we would take the stock off his hands at that $65 price and cover the difference ourselves. Yeah, right. I call it being the insurance company from hell. Collect lots of premium and then avoid like the plague ever paying out a claim. Now, the difference between providing insurance in the stock market via put selling versus real-world insurance companies that focus on property and life is that we can always renegotiate any policy we sell to Mr. Market. But first, let's look at Papa John's at that time as a potential investment instead of a put selling trade. So when we entered the trade, Papa John's was trading at $67.33 a share. The stock pretty quickly drifted lower and kept trading lower and lower and lower over time. At the lowest point, the stock hit $30.20 a share on an intraday basis. That's a 55.14% loss of value from our entry point. For anyone purchasing shares at the same time that we sold or wrote our puts, they would have seen a drawdown that cut their investment by more than half. Now get this, when we were finally able to exit the trade at that August monthly expiration date, the stock was still down 29.35% from our original entry point. So Papa John's has come back some of the way, but a stock-only investor would still be looking at heavy unrealized losses. Okay, number two, let's take a closer look at this put-selling campaign we did, insuring a stock against a decline, only to see the stock decline a ton. I swear, making money on losing trades never gets old. Here's a screenshot of the spreadsheet tracking the returns. I'm also including a link to this screenshot in the description section below if you want to spend some time checking it out in more detail. Now, obviously with a 473-day campaign, there's going to be quite a few rolls and adjustments and such, and I'm not going to go through each of these line by line, but there is a notes column on the right side of the table which should help explain what happened and when. But if you have specific questions about any of these transactions, please let me know in the comments section below and I'll try to clarify anything that's not clear. But I will give you a general overview of how everything played out and the rationale for different moves and adjustments. So inside the Leveraged Investing Club, we have a proprietary approach to fixing our bad option selling trades. It's called the 4-stage trade repair formula. Now, between the Great Option Trading Strategies website, my free daily tips newsletter, again, see the pinned comment section below for a link to sign up, and this YouTube channel, I basically give away 90 to 95% of everything we do inside the Leveraged Investing Club. But I can't actually in good conscience give away the proprietary 4-stage trade repair formula or the related timing adjustment cheat sheet. One tells us what to do, the other tells us when to do it. But I swear I talk about trade repair enough that if you're really motivated, it shouldn't be that hard to reverse engineer our process. But I can lay out some general principles here. First, when a trade goes against us, our first priority is to work the strike price lower on our now in the money short put position. But we have two requirements for rolling down and out to a lower strike price. One, we want a net credit, meaning we collect more for setting up the new short put position than what it costs us to close out the old or expiring short put position. And second, we don't want to roll too far out in the future. Except in rare occasions, we won't roll out more than 3 monthly option cycles. Anything farther out than that, and it's really an inefficient use of your capital and your time. As you can see in the spreadsheet here, there were some examples of that, where we were able to roll down and out from 65 to 62.50, and then again from 62.50 to 60. If we can't roll down and out to a lower strike in a reasonable time frame and for net credit, then we're content with straight rolls out to the same strike price and simply collect net credits that way. Here's a key concept with our put selling trade repairs. The more we're able to work the strike price lower on a trade that's moved against us, the less the stock has to come back and the quicker we'll be out of the trade. And the more net premium we're able to accumulate along the way, the greater our final returns will be. But in the event that the stock sells off so much that even a straight roll to the same strike price no longer produces a meaningful net credit, because again, we're not going to kick this thing out for a year or two, then we'll actually expand the trade and really adjust the strike price lower as a result. Here's a simple example to illustrate the concept. Say you have a single short put at the $70 strike price, but the underlying stock is now trading at $50 a share. That means your $70 short put is $20 a contract in the money. It has $20 of intrinsic value. And since it's a short position, that's not good. It means you're $20 a contract in the hole, or $2,000 per contract, since each contract represents 100 shares of the underlying stock. But you know what else has $20 of intrinsic value in that situation? 2 short puts at the $60 strike price. It's what I call the double half principle, and I go into more detail in Chapter 6 of my complete guide to selling puts on the Great Option Trading Strategies website. See the link in the description below. In fact, that's how we were able to work the strike price down from 60 to 50 in the spreadsheet here, by adding a second contract. And you guessed it, when we do that, we also want to pick up some more net premium. Now, one thing we did a little differently with this trade repair campaign, especially as the stock continued to sell off, is that we converted it from a short put campaign to a covered call campaign. Now, I want to be very, very clear. This is not a variation of the wheel strategy. Conversation for another day, and I don't want to step on anyone's toes for those who trade it, but I am not a fan of the wheel strategy at all. I think the accounting is unnecessarily complicated. It makes it easy to mask actual underlying losses. It can be challenging to have a true gauge of how the campaign is actually performing. It's easy to get whipsawed. It delays rolls and adjustments, and it encourages traders to stay in a campaign when it's no longer optimal to do so. Remember, as long as you're working with the same strike price, covered calls and naked puts are basically different ways to structure the same trade. They pretty much produce the same results, so it just makes no sense to me to keep flipping back and forth between naked puts and covered calls, especially when you're also likely going to be wasting time waiting for Mr. Market to assign a position versus making a timely adjustment yourself. But in this case, because of the quarterly dividend that Papa John's pays, I felt it was more advantageous to allow the short put to be assigned, accept the shares, and continue repairing the position while collecting the dividend along the way. So I allowed my 6250 short put to be assigned to me and then began selling cover calls on those shares. Later, I expanded the trade to include a second contract, but because I was now managing the trade on the covered call side of things, that involved buying another 100 shares on the open market. But using the double half principle here, look at how much we were able to reduce the strike price when we made this move. After buying those additional shares on the open market for $40.37 a share, we were able to convert what had been a single $60 covered call to 2 $50 covered calls. And then later, over time, we worked the covered call strike price lower one more time to the $47.50 strike. Now, with the stock eventually losing more than half its value on us, so that even our $47.50 covered calls ended up being far out of the money, which would be comparable to $47.50 short puts being deep in the money, the trade was eligible for one more expansion. But this time I did something a little different. Instead of doubling the contracts again and adding 200 additional shares in order to cut the strike price in half again, which also would have worked, by the way, I preserved some capital here and only bought an additional 100 shares, but these I treated almost as a separate trade. I didn't even try to adjust the $47.50 cover calls lower. I felt strongly that the stock was undervalued and would eventually rebound at least some. So I bought those new 100 shares on the open market for $33.42 a share, and then sold a slightly out of the money $35 cover call on those new shares. It was a nice setup. It brought in more net premium at an attractive rate, since a covered call wasn't that far out of the money, and I also set myself up for capital gains if shares traded higher, up to $35 a share. And if not, I would just start collecting the quarterly dividend while continuing to roll for more net credits over time. Now, what was really cool about that $35 covered call was that I was, in fact, able to collect premium on it multiple times. Meaning I sold the April $35 strike, rolled it to May for a net credit, and then rolled it again to July for another net credit. I would eventually be forced out of those shares as the stock continued to rebound, but that was always part of the plan. So I collected 3 rounds of covered call income, 1 dividend payment, and some capital gains along the way, i.e. buying those shares for $33.42 and being forced to sell them for $35 when the covered call was eventually exercised against me. Okay, to wrap up here, Papa John's did recover to a degree, and it traded around and above the $50 level for a couple of times, but there was just too much remaining time value on our main 47.50 covered call position for an earlier exit. But eventually, with the August expiration cycle, the stars aligned enough, and the stock closed at expiration just across the finish line at $47.57 a share, so that our 47.50 covered calls were automatically exercised against us at expiration, and we were finally out of the campaign, and with those fantastic returns. Also, some real quick housekeeping regarding the spreadsheet. I did have to make a couple of accounting adjustments. One which lowered our final returns and one which increased our final returns. Okay, bear with me as I briefly run into the weeds here, but adjustment number 1 reduced the returns because it raised the assigned cost basis on the shares for the main 47.50 covered call position from $47.50 to $48.93.5 as a way to account for, way back near the beginning of the campaign, when I converted the 62.50 short put to a covered call and worked the strike price down to the $60 strike, except I got less than the $2.50 net credit required to fully pay for that adjustment. Adjustment number 2 increased the returns because it added the capital gains on those 100 shares I purchased at $33.42 a share and which were called away at $35 a share. Okay, part 3 here. Why did this trade where the stock performed so horribly produce such great results for us? In my view, there were 3 key factors. First, the biggest factor came from those last 100 shares added at $33.42 a share that we then wrote covered calls on. Now, that didn't repair the trade by itself because the trade wasn't fully repaired until the stock recaptured and held the 47.50 level and those final 200 shares were called away. But it did bring in a lot more premium, especially when we were able to roll it twice after the initial setup. We also received 1 dividend payout on those extra shares and a very welcome $1.48 per share of capital gains when those shares were called away from us at the $35 strike price. Second, the dividends we collected, first on 100 shares, then on 200 shares, and finally on 300 shares, really added up. $322 of the trade's gains came from dividends. The stock was also scheduled to trade ex-dividend on August 18th or the Monday after the August monthly expiration, so we actually came very close to getting another round of dividend income. But if you back out the dividend income we did receive, the final annualized income would have dropped from 20.21% to 17.43%. And third, we also generated some pretty nice net credits, especially in the later rolls and adjustments. That's the advantage of working with options with higher implied volatility levels. Obviously, Papa John's options aren't outrageously expensive, but they are nicely elevated. Now here's a quick bonus tip. Option selling trades are often easier to repair on more volatile stocks where premium levels are much higher than they are with the options of more stable, boring, blue chip type stocks where premium levels tend to be much more anemic. Remember, at the end of the day, it's future time value and your ability to sell it that makes all option selling trade repair possible. And we also caught some breaks along the way that further helped to maximize the net premium we collected, including, as I've already mentioned, being able to get those 3 rounds of covered call income at that $35 strike, as well as that final August option cycle on our 47.50 covered calls where there was an earnings release which further boosted premium levels. But still, you might be thinking, 473 days. That's insane. Okay, I'll admit it, this one went on a little longer than I originally anticipated. Our target duration on new put selling trades inside the Leveraged Investing Club is somewhere in the 3-week to 45-day range. Because in my view, that's a really good balance between higher annualized rates available on shorter duration trades versus total premium dollar payouts available on longer duration trades. But there's definitely a trade-off when it comes to repairing a trade, and I'm the first to admit it. The cost of trade repair, the cost of making money on trades that blow up on you, the cost of tails Mr. Market loses is that you have to be okay with a certain level of uncertainty. The uncertainty is not, for the most part, whether or not you're going to be able to repair the trade. The uncertainty is how long is it going to take to repair the trade and what will the final returns be. And for some people, that may feel like psychological torture. Now, if you knew in advance what the final returns would be and how long a trade would need to be open, it's a different story. If, for example, I told you I had a guaranteed investment for you that would deliver 26.19% total returns or 20.21% annualized over 473 days, that sounds like a pretty good deal, doesn't it? You'd probably say, where do I sign up? But that's not how the process works. Sometimes trade repairs are relatively quick, like that ELF trade I mentioned earlier, where the stock fell nearly 35%, but we were successfully out of the position after just 85 days for 19.43% annualized returns. But I've had trade repair situations go more than 2 years before I was finally able to lock in profits. Now, the psychology does become a lot easier once you've successfully repaired some of these trades yourself and experienced firsthand how the process works and you realize, okay, yeah, I can fix this. Then it just comes down to how long will it take and what will the final returns be. And that's a much better place to be in versus stressing out how underwater the trade may be at any given point, worrying about how much worse it's going to get, or doubting that there's anything you can do about it except soak up a big fat loss. Now, the flip side of all this is that if you can get yourself psychologically comfortable with trade repair, if you can be okay with some ambiguity in terms of timing and not knowing what your final returns will be, you're going to have a huge advantage in the stock market. In fact, with my mindset, I don't see trading in terms of winning trades versus losing trades. My attitude is that, except on rare occasions, they're all winning trades. It's just that some of them are going to generate higher annualized rates and some of them are going to generate lower annualized rates. Okay, we'd love to hear your feedback, questions, etc. Or if there's some other part of this process you'd like me to cover, let me know in the comments below. And if you enjoyed this and want more, be sure to check out the channel's other videos. I took some time off from YouTube, as in a few years, but I'm adding new content on a regular basis now, and those videos are starting to add up. Also, sign up for the Daily Tips newsletter via the pinned comment below. Options are the ultimate high-yield income vehicle, and they can be structured in so many different ways to generate sustainable and safe high-yield income. The Daily Tips newsletter is a perfect complement to this channel because I can cover more topics, and sometimes deeper, in written form versus video form. You can sign up directly, or there's also a link in the description section below to the Great Option Trading Strategies downloadable library page. Download anything from there, and you'll also begin receiving the Daily Tips newsletter automatically. Heads we win, tails Mr. Market loses. That means you should be coming out ahead on virtually all of your trades. Okay, until next time.